All right, folks, welcome to Investing for Beginners podcast. Today, Andrew and I are going to continue our exploration of the income statement, and we're going to do a financials demystified, and we're going to talk about everything outside of EBIT or operating income. So everything below that is going to be on the table today. This is Andrew's favorite discussion, favorite topic, so we're going to have some fun today. So Andrew, why don't you kick us off today?
Yeah, if you guys don't end up stabbing your eyeballs and having your ears bleed, then this episode has been a success. So first, let's talk about why these things matter. It's probably an overlooked component, and I would admit I probably overlooked this a little bit too much too. But it does make an impact more in the short term than the long term. I kind of look at it like a blocking and tackling. When companies have to do accounting and they have to do lawyer stuff, it's blocking and tackling. So when it runs smoothly, you don't even realize it's happening. But when it doesn't run smoothly, sometimes that could be symptomatic of bigger issues. So you want to be able to check it. And I think to me, it's fascinating to know. So you're going to just have to grind through this. Let's talk about taxes first. Well, actually, I kind of want to back up for a second because a company lifecycle will determine oftentimes which parts of these are relevant to a company. So maybe Dave, you can give us like a super bird's eye view of company's general life cycle, and then I'll touch on which parts of this income statement tends to affect certain companies more than others.
Yeah. Okay. Good. Very good point. So when you're looking at a company and you're trying to determine their financials and how to interpret them, one thing to keep in mind is where the company is in its life cycle. So as a general rule, a company will go through a life cycle just like we will as humans. And so when they start off, they're young, they're generating revenue maybe, and they are not generating a lot of profits. And so they will be very young in their life cycle. So think maybe IPO companies or pre-IPO businesses. Then once a company comes public, for example, then they will still be generating a lot of revenue and very typically not a lot of profits, but they're still very young in their stage. And as the company kind of moves through its life cycle, it will continue to generate revenues. Profitability will start to increase. At some point, that will start to flatten out, and the company will start to become more mature. And as our friend Brian Feroldi would say, it's optimized for profits and it's able to fully fund itself. And companies can stay in and out of these cycles for many years. They can oscillate back and forth between these cycles many times in their lifetime. And then at some point, a company starts to become over mature and will start to decline. Revenues start to fall. Profitability stays really high, but the company just has nowhere to go and has nowhere to grow, and it becomes obsolete and eventually will die. So that is kind of the life cycle. Not to be Debbie Downer, but yeah, every company will eventually meet its end.
Yeah, totally. So if we're to look at the beginning parts of that, Warren Buffett, one of these obscure nuggets, I remember reading a write-up he did where he had discovered hidden value in tax-deferred liabilities. Or I'm sorry, tax-deferred assets. So if Warren Buffett did it, maybe one of us could do it one day too. But basically, to Dave's point, when you are a young company, a lot of these companies are reinvesting for growth and trying to go growth for good reason, so they can hit scale and become a leader in their industry and become the undisputed leader, ideally. So as they do that, they get losses. Rather than a company who's optimized for profit has profits, they pay taxes on it. A company that is losing money has the opposite situation. So if you've ever had the pleasant fortune of having bad stock picks and getting a tax write-off at the end of the year because of that, it's very similar for businesses. And what businesses can do and often do is they defer those write-offs, and it becomes an asset on their balance sheet. And so that's essentially future free cash flow that they are able to offset future taxes using these deferred assets. And so, yeah, it can be a hidden source of value that is not immediately apparent when you're looking at the income statement, maybe you're looking at the balance sheet, but it becomes apparent in later years because it gets reflected in the income statement. And that's sometimes where you can see earnings and or free cash flow that is higher than if you were only looking at EBIT, only looking at the operations of the business. And if a company is good at managing their money, maybe they can add an extra level of growth, make a savvy acquisition, do these things that create growth above and beyond what the operating business would have been able to do. So, as an example, if we have our ice cream shop that just went public and we are not making money on the stores, so we can reinvest and we're building more stores and we're securing outside financing and all of those things. If we were first 3 years, we lost $100 million. Then year four, if we made $100 million, or were to pay $100 million in tax, I think would be an easier way to say it. You can offset the $100 million loss from before, use that to offset the future. And so where year four without that deferred tax asset, you would have had to pay whatever the corporate tax rate is at the time and where you operate. That money that would have been deducted from net income is no longer deducted, so that net income is now higher and it's closer to your EBIT. And yeah, that can be like a cool little nugget, little short-term value finder when you're looking at different businesses.
Yeah, that's awesome. Yeah, that's awesome. I remember Buffett talking about that, wasn't it, in one of his earlier partnership letters, I believe, that he made that discovery.
Yeah, he was probably still doing the whole deep value game.
Yeah. 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 So that was pretty impressive. So when you're thinking about taxes and how it impacts the analysis of a business, do you look at the life cycle of the business and try to determine maybe how relative that is for the company? And I guess the second question is, every company has to pay taxes, right?
Yeah.
Yeah.
Well, let's be clear. What is the 3Ds, right? For people, and it, I guess, applies to businesses as well.
Yeah. Yeah.
I can't remember what they are.
No, I don't either, but I know what you're talking about.
Okay. Yeah. Anyway, I don't analyze businesses anymore, but when I used to, if deferred taxes or deferred liabilities seemed really large, then that could be something to dig into. You can go as deep as Mobison. He calculates ROIC based on what's the cash tax shield, which is a whole nother level. But if you're looking at investing in businesses for the long term, you probably don't have to go that deep into it, unless, again, like I was mentioning, if a number looks really big, that is bigger than normal, then you do want to do the extra digging. Something I will say about that's interesting, and it was a hot topic for a couple of years, and it's kind of faded in relevancy, but companies will have different tax rates depending on where they do business. So a more international company like a Visa or a MasterCard or Microsoft, where there's a lot of revenues outside of the United States, you'll see a lower tax rate, tax percentage. They call it an effective tax rate. You'll see that will be lower than a company like Martin Marietta, which is all US based, and they're paying the US corporate tax rate, which was, 25 or something. So you do see a bigger difference. And again, if you're only focused on EBIT, that can be a problem because you're not really going to get the full breakdown of how EBIT actually turns into earnings, which is another way of saying also free cash flow. Over the long term, earnings and free cash flow tend to be equal, but the taxes and the interest do play a role in that.
Mm-hmm. Yeah, for sure. I know that I was reading about Visa and MasterCard recently. The companies have not done as well in the market. There's been some pessimism around the businesses. And one of the reasons is their tax rate has been a little more elevated recently. And that stems directly from, I think it might have been Europe, that passed a law mandating a minimum of 15% tax rate for global companies. meaning that when MasterCard generates revenue from Thailand, for example, they're going to pay a minimum of 15% tax rate on that income. And so that has raised the Visa and MasterCard's tax rates 2 or 3% over the last 3 or 4 quarters, which has caused them to be slightly less profitable than they have been in the past. So it does make an impact, and it is something you do need to keep aware of and be cognizant of as you're analyzing any company. So it was something I admit I was not aware of, and then it was brought to my attention, and then I read about it and I'm like, okay. So it was good information to know.
Yeah. Is it? I'll just speak kind of how I see it. Is when it comes to taxes, I'm going to assume that with the errors of assumption that are there, assume that whatever the company's current tax rate will probably continue. I remember a lot of people talking about, new administration, what's that going to do to the corporate tax rates? And they're talking about Biden, and I remember that being a big thing back in the day. But if you're buying stocks, any changes to the tax code are going to hit every stock. So yes, the valuation for every stock will probably change if corporate tax rates change. But what is the point in adjusting your DCF by whatever percent for every company you look at if you're still going to pick stocks, so they might be more equal than others? I don't know. I mean, if we're talking about global tax maybe versus a domestic tax, then I could see some validity there. But it becomes hard when you invest, especially when you're digging into the nitty-gritty of the financials. You kind of always have to make that decision. How much of this am I really going to have affect which stocks I buy? And how much of this am I going to let go and kind of just say, you know what? Most of the companies I buy are going to figure this out. Most of them are going to do the blocking and tackling. It's not always an easy thing to decide to what scale are you going to make that assessment about a stock.
Yeah. I would totally agree with that. I think I remember watching a valuation seminar from Professor Demoterin, and when he was talking about taxes and kind of how to deal with it as far as valuing a company, he was basically of the opinion, I'm going to paraphrase, pick a number, don't be a hero. There's more important parts of the DCF than the tax rate.
Love it. Yeah.
Yeah.
Oh, that's perfect.
Yeah. Yeah. I love that. I very strongly remember don't be a hero.
Yeah.
There's other parts that are more important. Okay. All right. Fair enough.
Right.
Yeah. Fair enough. All right. So let's move on to maybe some other line items from the income statement that we probably should be aware of. One in particular, interest expense.
Yeah. And tied with interest income too, right?
Right.
And interest expense being important because interest expense, when it becomes too high, it can really pressure a company. And then you will see companies behave in ways that a desperate company would behave in. And so even though interest expense may be high, maybe Wall Street doesn't recognize it's a problem until they go do something silly like sell a unit that was growing really fast, and just because they have a lot of interest, and you're like, then you're shaking your head wondering why they did that, and the stock is down, and maybe it was because they were pressed by interest expense. But interest expense being the interest that companies need to pay when they issue debt. I do strongly, based on the way I've perceived the market, which is admittedly a narrow approach because I've always stuck to companies more on the profit optimization, capital return phase. Those businesses tend to borrow more, especially the later towards that capital return phase you are. You'll tend to see more companies borrowing, whereas the younger companies who are still trying to make profits, from my understanding, people don't want to finance companies that aren't making profits unless there's some additional upside. So you'll see a lot of debt, like convertible debt, for example. So that might come with an interest rate, but a vast majority of the financing is based on that call option that the lender gets. Basically, okay, if your stock goes this high, I get shares of your company instead of only just getting the interest for the debt. So that's why, again, we're in the beginning. The beginning companies, maybe you're looking more at that deferred tax asset type deal. The more mature companies, you're looking at this interest expense because that is something that needs to be managed. And we're all seeing right now how the government is having to deal with interest expense. And it is almost like compounding where, and as interest rates rise, an interest expense that was a problem in the past now becomes even more of a problem because you're refinancing at higher rates. So I think ways to look at interest expense that we all do, and if we don't, we should, would be something like a interest coverage ratio. Do you want to start with that one and kind of explain what that one is and why it's helpful?
Yeah, so the interest coverage ratio is a way of measuring how much is the company having to pay in debt payments compared to the earnings that the company generates. And so the mathematical way you compare it is you look at the interest expense that you would find on the income statement. You would compare that to the earnings before interest and taxes, or EBIT, and that gives you a coverage ratio. And basically what that tells you is how many times over can the company pay for the debt that it is having to pay. This doesn't cover the actual debt repayment, it covers the interest expense on that debt payment. So the vast majority of debt that we deal with, especially Andrew and I dealing with more mature businesses, is the money they get from generating interest in the bond market. So they basically entice investors to invest in the debt of Microsoft, for example, and then the payment that investors get for making that investment, that's the interest expense. And so that's what they're covering. And so a good way to look at this is the higher the better. I think a good cutoff. Most companies, if you see anything under two and a half times interest expense, run far away. And the higher the better. So sometimes you'll see companies that have 100 times interest expense, and that's awesome. It means that they're in a very strong position. So that's how I look at it.
Yeah. Perfect. What about interest income? Let's talk about that other side because it's like what, a
What?
company like Google gets interest
Yeah.
income. Like,
Interest
tell me
income.
more.
Tell me more. So interest income, it can be an amalgamation of different sources of income. So when you look at the income statement, you'll sometimes some companies will put interest expense and interest income. Sometimes they'll combine them, and so you may see a positive or a negative number. So it can be a little bit confusing, and you'll have to use Control F to dig a little bit deeper to find out what the exact numbers are all the time. So, interest income is the money that they make from investments that they make. So, when you look on the balance sheet, you'll see cash and equivalents. You'll see short term investments, which are typically in bonds or money markets or things of that nature. So, the money that Google makes from those short term investments is interest income. If the company invests in other businesses, let's say they take a 20% share in Meta, not that they ever would, but let's say that they did, then any money that they make from that investment goes as part of their investment income. And so all those things kind of play into the investment income of a business. And in some cases, companies that have a very large investment portfolio, I'm looking at you, Berkshire Hathaway, this can have a big contribution to the company's income overall or the loss of the income. And so that's one thing to always kind of keep in mind when you're looking at the income statement of the company is where are all their profits coming from? And this is one of the places it could show up.
Yeah. And if you're looking at like a bank or a Berkshire or an insurance company where their primary money making is on interest on investments or interest on loans that they're making, then you will see that the whole income statement's transformed and it looks completely different and it becomes a much bigger impact. So, where a traditional, I'm putting that in air quotes, company, you look at gross margin, operating margin, which is EBIT, and then everything else, which is today's episode, gets you to earnings. For a insurance company or bank, that interest expense, that interest income is a prominent role, and that's calculated more so than a gross margin or operating margin would be.
Yeah, yeah, for sure. The last thing I think I will throw out there about this particular line item is to keep in mind is if the company has a large equity portfolio, again, Berkshire, Markel, some of the big hyperscalers will have investments in other businesses. Those investments are mark to market. So every quarter they will assess what is the value of Buffett's investment in Apple, for example. And if it's up, then that improves the interest income of Berkshire Hathaway. If it's down, it could negatively impact the interest income of Berkshire Hathaway. Even though they have not sold any of the investments and realized any of the profits, the powers that be decided for GAAP accounting rules that equity investments need to be unrealized or realized gains. And so those have to be marked on the income statement. And so it's very important to be aware of that, especially with companies that have larger equity investment portfolios, because that could have a huge swing depending on how the market's going on what you see on the income statement. And sometimes you'll see these headline articles, screaming, Berkshire Hathaway earnings down 30%. And at first blush, you can go, holy crap, that's terrible. But then when you dig a little deeper, you realize it's all coming from the interest income, which is coming from the stock market has been performing poorly for the quarter. Then Buffett's investments are down. Then that's negatively, and it has nothing, I repeat again, nothing to do with the operations of the actual business. And so it's something to be very, very aware of. And other reason why I mention this is when you look at Amazon, you will see this fluctuation from time to time with their company because they have a pretty big stake in Rivian. And so because of that, the market sometimes loves them and sometimes hates them, and that impacts the financials of Amazon, again, while not relating to the operations of the business in any way, shape, or form. So it's something to always keep in mind when you're thinking about this.
So you own Berkshire.
I do.
Uh, so rather than looking at earnings, because you know that earnings will be impacted by the fluctuations of the stocks that they own, what are you looking at instead to decide whether things are smooth sailing or whether, oh, I want to look deeper into what happened 2 quarters ago or something like that?
For me, I look at operating income for the business, and that's as far as I go. I don't, when I look at them, that I don't, I mean, I'll look at what's happening with the interest income and whatnot, but I will look at the operating income of the business because that's really where the money is made, is the operations of their insurance businesses as well as all their other either wholly owned or partly owned businesses. And that's where I'll look to see how their company is doing.
Other kind of items that I almost feel like we just have to do housekeeping on, which are boring, but we'll just include them. Things like accumulated other income. Sometimes when companies have changes because of Forex, I might be doing business in India and then I get paid in a rupee. And then by the time I convert it to US dollar, the value has changed. Things like that can be in accumulated comprehensive income. And you will see that kind of chunk in the financial statement oftentimes after the income statement or sometimes at the end of all the financial statements. So if you see that, you're like, oh my goodness, this all looks crazy, right? I would kind of categorize it as like, yeah, it probably plays an impact in earnings. Wouldn't stress about it too much because it's just blocking and tackling, and hopefully it's a well-run business, which means they're doing their blocking and tackling. Other pieces around EBIT that I think are helpful would be all around footnotes. We haven't really talked much about footnotes, especially around the income statement. That can be a treasure trove of information. And while the income statement can give you a big picture of maybe a business and how it's doing and all of these things and what their margins are and all of that, the footnotes will give you a lot better insight into some of those numbers. So, for example, let's say I'm going to pick a company like American Eagle because I used to own it way back in the day. So, if I don't know about the store operating expenses, things like that, I can look in the footnotes and it will tell me whether they record those expenses as cost of goods sold or as selling general and administration. So that can help you understand if gross margin change. You can go in the footnotes and look to see what are they including in cost of goods sold, how are they calculating gross margin, and then you'll get better insight into if those numbers are down, maybe it's because of this or this. It's kind of
Yeah,
like double checking, you know, what management's saying.
yeah. The notes is a treasure trove of information, and when you're more curious about different aspects of the business, it's a great place to go hunting for what is really going on with the business, because the in large part the big three of financial statements are generally formalized in that they will tell you a lot of the same things. So if you look at if you want to know more about, to Andrew's point, about what is directly in a cost of goods sold versus maybe R&D, and you don't know, a place you can go to try to determine that is a place like the notes section. For example, if you wanted to know about, okay, how is stock-based compensation really lining up in the income statement, because they won't always tell you exactly. You'll just see a line item in the cash flow statement, but you won't necessarily know where is that being applied in the income statement. And so you'll find information like that. Another interesting tidbit is depreciation. Where is depreciation and or amortization lining up in the income statement? And that can tell you a lot about where the company is spending their money and how that's impacting the decisions to grow or not grow. We were talking on an earlier episode about CapEx spend, and a big question that's going to be coming over the next few years is whether all the money that these companies are promising to spend, is that growth CapEx or is that maintenance CapEx? And you could use some of that information from the income statement notes to help you determine whether this is true or not. And I guess the last thing I'll mention about notes is, I mentioned earlier about kind of the breakdown of where maybe interest income is coming for the business. It may not be critically important to figure that out for Microsoft, but it will be critically important to figure that out for a bank or for an insurance business. And you want to know, where are they driving their money from? Is it all coming from equity investments, or is it all coming from more, I guess, stable investments like a bond or a money market fund? And that'll also give you some insight on how much you expect it to grow. And if it's coming from more conservative investments, then you can't expect a 10% return on the money for that business. Whereas if it's coming more from an equity investment or something similar to that, you may be able to expect a bigger return. So to me, that's where a lot of the places I'll go hunting for that information is in the notes.
Yeah, like the banks will put their loan book in the notes, and you kind of have to search through, but that's where you'll find it.
Yeah.
Okay, we do this much in commercial real estate loans, and we do this much in residential mortgages, whatever. It'll all
Yeah.
be in there.
Yeah, for sure. Well, the other interesting tidbits in there is you can find out when a lot of that matures. You can also find some information about how much they're paying for that debt. So if they borrowed a bunch of debt 5 years ago, it's probably really low, and if they borrowed it maybe 2 years ago, it's maybe 5.5%, and 5 years ago was only 1%. And so that can give you some insight too into what their interest expense could be going forward as they pay off some of that older debt. That you won't be surprised if you see that the interest expense rises because the debt now is more expensive. And so that will have an impact. And so that's a good way to kind of anticipate, okay, is this going to go up or not?
You know, looking at what interest expense did Apple pay on its 2029 debt, that they issued in 2021, is probably just as exciting as looking at what was Shohei Ohtani's RBIs in 2019.
Yes.
It's fun. It's fun
Yeah, it's
if
fun.
you want to go look. Yeah.
Yeah,
Go
if
take a
it's
deep dive.
if those are the kinds of things that you get excited about, then the notes to financial statements are your jam.
Yeah. Anything else related to income statement that you might find in the notes that just kind of jumps out to you to be like, maybe circle back and look at it, or do you feel like we've covered it pretty well already?
I think I think the only other thing that I would probably look at would be some sort of information related to either segment revenues or geographical breakdown of the business.
Mhm.
Because to the point earlier about taxes, if you see that the vast majority of the business income or revenues is generated abroad, then you have to have, I guess, a different expectation for the tax rate than you would if it was all generated here. Like Martin Marietta, wholly owned, operated in the United States, is probably going to have a higher tax rate than a company that operates more so outside of the United States. So that, well, you can't compare apples to apples, especially if you don't know that information. So to me, that's something that's important to understand and be aware of.
Yeah. Well, and the things it tells you about the core operations of the business too.
Yeah. Yeah. It could be very illuminating.
So I have a super important question to ask you. Do you do you wish that Google would pay down would take their investments, let's call Apple, Google, and Microsoft. Do you wish they would take their long-term, short-term cash investments and use it to buy back stock? Or would you rather they keep that stuff on the balance sheet, keep earning interest income from it?
I think I would rather them buy back shares. I think
Mm,
in the long run, I feel like that is going to be a better return on the investment than holding that much cash. And I would probably say, if we're including Apple in this grouping, I would say they've probably done a really good job of that. And I think if you look back at their cash pile from 10 years ago to today, it's quite a bit less. And I think if you think, oh, well, hey, that means Apple's in trouble. No, it means that they've been returning capital to shareholders in a large part via this method. And Google and Microsoft, I feel like, are a little bit different beasts because they're still super, super profitable. Not that Apple isn't, but they're super, super profitable and they can easily build up that cash pile fairly quickly if they chose to. And so, but I would rather see Apple I would rather see Apple buy back shares. And likewise, Berkshire. I'd rather see them, if they're not going to pay a dividend, I'd rather see them buy bigger chunks of shares back, because 350 billion or whatever their cash pile is kind of getting kind of nuts.
yeah.
Um, I mean, it's like, I know Buffett's stepping down and that's going to be Greg Abel's headache to deal with, but really, what are you going to buy? What can't you buy with 350 billion in cash? I mean,
Yeah.
other than the hyperscalers, there isn't a lot that they can outright just buy. And so,
Mm,
you know, what's a better return for us as investors? Is 4.5% of a bond or buying back shares of Berkshire? I would argue buying back shares. So I guess that's my
mm,
thought. What are
yeah.
your thoughts?
No, I agree.
Mhm.
Makes all the sense in the world.
Yeah. All right, Sundar and Satya, gotta get busy, guys. Get busy.
IFB has spoken.
Yeah, IFB has spoken. Well, with that, folks, we will go ahead and wrap up our conversation for today. I hope you enjoyed our demystifying financials and our exciting, exciting look at taxes and other fun items today. Important stuff, good to know, and could be very helpful, especially the note part of the income statement. So, as we go forward, we will continue to try to demystify financials in the future. So with that, I'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to y'all next week.